For those paying close attention to silver, January 9th was not just another date. It was a signal, a marker, a moment where several powerful forces quietly converged, revealing something far larger than a routine price fluctuation. Silver recently dipped below $80 per ounce. On the surface, it looks like a simple pullback. Investors might shrug it off, saying profit-taking or market correction. But if we look deeper, this is no ordinary move. It is a signal, a marker pointing toward fundamental changes in the market. To fully grasp why this matters, we need to step back. In just 12 months, silver has surged from around $30 per ounce to over $70, a gain of more than 150%. That is astonishing. For context, that's a level of growth not often seen in a metal that has been ignored for decades. This breakout shattered a 40-year psychological ceiling, a barrier that had repelled every serious attempt at long-term gains since the early 1980s. This surge didn't happen in a vacuum. It occurred after 5 consecutive years of global supply deficits. Year after year, the world has consumed far more silver than it has produced. And yet this structural imbalance has often been overlooked by casual investors. Meanwhile, in China, the largest physical silver market in the world, trading platforms were reporting the lowest inventories in 10 years. Physical silver was disappearing from vaults, lease rates were climbing, and borrowing costs surged. This is not a paper phenomenon. It is a physical supply squeeze, the kind that can trigger enormous price movements. In the United States, analysts were sharply divided. Some projected silver hitting $100 per ounce in the near term, while others suggested it could reach $175. The split wasn't a weakness. It was a sign of a market in transition, where old rules no longer applied. And then came January 9th. Traders opened their screens to see silver trading at around $77.2 per ounce. Not a record, not a dramatic headline, but highly significant. Just 2 days prior, silver had been above $80. Optimism was high. A 3-day surge had fueled hopes for continued gains, and then momentum broke. News outlets called it routine profit-taking, a standard pause after a rally. But anyone who has followed silver closely knows the story goes much deeper. Let's rewind. A year ago, silver was stagnant, $30 per ounce, predictable, calm, almost boring. Few investors paid attention. By December 2025, that same metal had soared to $70, a gain that left latecomers wishing they had acted sooner. January 9th, however, was not the end of that journey. It felt more like the opening act of a new chapter. Analysts were not guessing when they mentioned support zones around 73 and resistance near 82 to 85. They were interpreting subtle signals, fundamentals, technical patterns, and geopolitical cues invisible to most observers. The broader macro context was crucial. The US dollar was strengthening, which traditionally puts downward pressure on commodities. Key economic releases were looming, and the Federal Reserve was preparing to make decisions that could reverberate globally. While most economists expected steady interest rates, comments from Fed Governor Stephen Moran suggested forceful reductions might become necessary to maintain economic growth. This uncertainty, combined with rising geopolitical tensions, U.S. activity in Venezuela, and escalating friction between China and Japan, created an environment where physical assets like silver became highly attractive. And this brings us to the real story: supply and demand. For the 5th consecutive year, global silver consumption exceeded production. In 2025 alone, the shortfall reached over 63 million ounces. This is not a trivial number. It represents a structural imbalance, one that cannot be corrected by speculation or paper trading. Unlike most metals, silver is rarely mined for itself. It is usually a byproduct of gold, zinc, or lead mining. You cannot simply ramp up production in response to price increases. The metal is constrained by geological realities, mining economics, and the priorities of primary metal producers. At the same time, industrial demand is exploding. Solar panels consume more than a quarter of annual silver production. Electric vehicles require silver for sensors, wiring, and advanced energy systems. The AI boom, massive data centers with thousands of high-performance servers, adds another layer of consumption. Silver is critical for conductivity, heat dissipation, and durability in ways no alternative material can match. In essence, silver has transformed from a simple investment into a strategic necessity. Its industrial applications, combined with its historical role as a monetary hedge, make it unique among commodities. Let's also consider investor psychology. For 4 decades, silver repeatedly failed to sustain prices above $50. Investors reacted with fear, haunted by memories of the 1980s spike and collapse. The 1990s, 2000s, and even 2011 delivered volatility but no lasting gains. 2025 changed all that. Silver completed a multi-decade cup-and-handle formation, one of the most powerful technical patterns in the market. 40 years of consolidation, capped by a perfectly formed breakout. When silver finally surpassed this structure, the market's psychology shifted permanently. Momentum gathered quietly at first. By March 2025, silver had reached 36. Encouraging, but not extraordinary. By August 14th, it cleared 38 decisively. And on October 17th, silver surged past 54, shattering the 40-year ceiling. Institutional investors, pension funds, sovereign wealth funds, and major banks maintained substantial holdings, confirming this was a structural shift, not a speculative frenzy. The combination of physical scarcity, industrial demand, geopolitical risk, and central bank policy created the perfect storm. And that storm is now visible in the January 9th price action. But there is more. China, in particular, has changed the game. While Western markets often operate largely in paper contracts and speculative positions, Chinese investors are quietly securing physical silver. Insurance companies, pension funds, and sovereign wealth funds have adjusted strategies to prioritize actual metal over paper exposure. This reduces available supply, drives prices higher, and reinforces the cycle of demand. The global silver market is now bifurcated. One side, the paper market, dominates in the West, dominated by electronic contracts, futures, and ETFs. The other side, the physical market, is concentrated in Asia, dominated by real metal held long-term. This duality creates tension, volatility, and opportunity for investors who understand where the real value resides. January 9th illustrates this dynamic perfectly. It was not about a simple correction or headline-driven move. It was about recognition. Recognition that silver's market has fundamentally changed. It is now an industrial cornerstone, a strategic asset, and a rare store of value all at once. What does this mean for you as an investor, observer, or strategist? It is not about predicting tomorrow's price. It is about understanding the forces shaping the market today: supply constraints, surging industrial demand, geopolitical uncertainty, and evolving monetary policy all converge to define a market that behaves very differently from anything in recent decades. Silver is no longer the silver of 1980, 2011, or even early 2025. Structural imbalances are real, persistent, and global. Human behavior in markets is shifting. The patterns of fear and hesitation are giving way to a market that rewards foresight and understanding over speculation alone. In short, January 9th may be remembered not as a day of panic or profit-taking, but as a moment when the market signaled a new chapter, an era where silver is recognized for what it has always been: a finite, indispensable, and increasingly strategic resource. The story does not end with a price number. It ends with awareness, with comprehension, with recognition that the forces shaping silver today, scarcity, industrial necessity, geopolitical dynamics, and monetary policy, are active, measurable, and actionable. So, as you consider your next move, remember this: silver is no longer just a commodity. It is a signal, a hedge, a strategic asset, and a barometer of global economic health. The market is whispering, and if you listen closely, it tells a story far larger than any daily price chart. If you enjoyed the video, like, share your thoughts in the comments, and subscribe to the YouTube channel so you don't miss out on the next important analysis update. Thanks for watching, and I'll see you in the next one.